Kevin is buying a vehicle with an out-the-door price of $46,000. After a $6,000 down payment, he needs to finance $40,000. His credit union offers him a 72-month loan at 6.49%. The payment is about $672 a month. Then, the dealership lowers his payment to $633. That sounds better. But the dealer did not lower the price. It raised the rate to 8.49% and stretched the loan to 84 months. Kevin saves $39 a month and pays almost $4,800 more. And before he signs, he uses one sentence that forces the dealership to compete for his financing business. When a salesperson asks, "What monthly payment are you trying to stay under?" the question sounds helpful. And the payment does matter. Kevin needs to know whether the loan fits his monthly cash flow. But the problem begins when the payment becomes the only number being discussed. A dealership can change the vehicle price, down payment, trade-in value, interest rate, loan term, amount financed, or add-ons and still make the payment land near Kevin's target. The monthly payment is not fake. It is just incomplete. Let's compare Kevin's two offers using the same $40,000 loan. The credit union offers 6.49% for 72 months. Kevin's payment is about $672. Over the full loan, he makes approximately $48,400 in payments. That includes about $8,400 in interest. Now look at the dealership's lower payment offer. The amount financed is still $40,000, but the rate rises to 8.49%, and the term stretches to 84 months. The payment falls to about $633. Kevin saves $39 each month, but he also makes 12 additional payments. His total interest rises to approximately $13,200. His total loan payments rise to about $53,200. The dealership lowered his monthly payment by $39 and increased his total cost by nearly $4,800. A lower payment did not create a better loan. It simply spread more cost across more time. The vehicle purchase may contain 4 separate negotiations. The price of the vehicle, the value of Kevin's trade-in, the financing, and any warranties or dealer add-ons. When those 4 decisions are blended into one payment, Kevin can no longer see which part of the deal improved and which part became more expensive. The dealer could raise the trade-in value, but also raise the vehicle price. It could lower the payment by extending the term. It could offer a lower rate, but include thousands of dollars in additional products. Or it could describe every add-on as only a few more dollars per month. That is why Kevin negotiates the out-the-door price before discussing how the purchase will be financed. Kevin's strongest move happens before he walks into the dealership. He gets a financing offer from a credit union, bank, or another legitimate lender. That gives him a real benchmark for the interest rate, term, estimated payment, amount financed, and total borrowing cost. But Kevin does not walk in announcing that he is approved for up to $50,000. He does not reveal the highest payment he can afford. And he does not immediately tell the dealership the exact interest rate it needs to beat. First, he negotiates the out-the-door price. Then he says, "I already have financing available through my credit union, but I am not committed to that lender. You are welcome to compete for the financing." That changes the conversation. The dealership knows Kevin has a credible alternative and can complete the purchase without depending on its lender. But the dealership still has an opportunity to earn the financing business. If the dealer asks for Kevin's exact outside terms, he can say, "Let's see your best offer first. Then I'll compare the APR, term, amount financed, and total cost against the financing I already have." Kevin is not asking the dealer to match a payment. He is forcing it to compete on the complete loan. And Kevin should not avoid comparing lenders because he assumes every auto loan application will damage his credit separately. Qualifying auto loan inquiries made during a focused rate shopping period are generally grouped as one shopping event for scoring purposes. Because credit scoring models vary, keep the applications within 14 days when practical. Some models may use a window as long as 45 days. The individual inquiries may still appear on Kevin's credit report, and this treatment applies to shopping for the same type of loan, not unrelated credit applications. Before Kevin signs, he runs 5 checks. First, the price test. Second, the loan test. Third, the payment test. Fourth, the equity test. And fifth, the competition test. Kevin's dealership offer fails the money stress test. This offer fails because Kevin borrows the same $40,000 at a higher rate, stays in debt for another year, and pays almost $4,800 more to save only $39 a month. The credit union offer is better. Before visiting the dealership, get a financing benchmark. Negotiate the out-the-door price first. Then invite the dealership to compete for the loan. Do not ask only whether you can afford the payment. Ask what the deal will cost, from the first dollar to the final payment.